households that experience a redundancy or significant loss of income as a result of the downturn will be able to defer a proportion of their interest payments for up to 2 years while they get their family finances back on track. This measure is in addition to our protection for the unemployed, who after 13 weeks can claim help with a mortgage. This measure will extend protection for those in work as well as those out of work and be available at a higher level of income.
It's aimed at Middle Britain, perhaps a family where one of the earners has lost their job or been forced to take a cut in income. Mortgages up to £400,000 are covered. Anything on top of that isn't included. You'll be able to defer up to 100% of your interest payments, and if you have large savings, you have to use them first. But there is a catch. The money will be added to the outstanding value of the mortgage. So on a mortgage of £100,000, your interest payment will be around £6,000 a year. At the end of 2 years, you'd have to start paying your mortgage again, and then you'd owe £112,000. But you would still be in your house, and after 2 years, you'd hopefully have sorted out your financial situation. If after 2 years you still couldn't pay and your house was repossessed, the government would pay your bank the extra £12,000. But it wouldn't face that bill until after the next election. The Tories were unimpressed.
There are some very important questions about what is the taxpayer return, what is the fee going to be paid to the taxpayer, what is the proportion of interest that someone who is in danger of repossession is going to be able to roll up. The Council of Mortgage Lenders have already put out a press release saying the devil will be in the detail, and it's pretty clear from the early conversations I've had with the industry that not many people have been consulted about this.
The government says it's done the deal with the UK's 8 biggest mortgage lenders. Nationwide has confirmed to Newsnight that it's fully signed up to the deal. But senior sources in some other banks have privately indicated to the BBC they're not entirely happy at the prospect of being strong-armed into keeping feckless borrowers in their houses. But it's not just the feckless who are at risk. It's now looking as though repossession levels in the UK next year will be similar to the early 1990s. So if 50,000 customers of the 8 biggest lenders get to stay in their houses because of this, the government will be taking on a worst-case scenario liability of £1 billion. But that would only be if they all had their houses repossessed 2 years down the line. Government sources expect the actual cost will be 1/10 of that. And that may be a small price to pay if it raises confidence and keeps a large number of people in their houses. But there are 2 big groups of people that it won't help. Firstly, anyone who took out a mortgage with a company that isn't involved in the scheme, and that's most of the big subprime lenders. Secondly, anyone with a secondary loan secured against their property. People often described in the newspapers as using their houses as a cash machine. So, will it stop the plunge in house prices?
I think it's certainly premature to talk about them putting a floor under house prices, but the fact that there probably will be less distress selling in the marketplace should be a supportive influence, and it should perhaps moderate the extent of further declines.
If that's right, the current fear of repossessions could crumble, instead of the housing market and possibly the government's electoral prospects.